Hey everyone, this is Kirk here again at OptionAlpha.com. Hopefully you guys had a wonderful holiday. Merry Christmas to all of you guys who celebrated Christmas. It was a very, very quick week already. We're into Thursday, the end of Thursday, and then we got Friday left. So fairly short week with early close on Tuesday and then a no market activity on Wednesday. So I did have a video. I didn't get a chance to do a video on Wednesday, Christmas Day for Tuesday. So I want to kind of recap some of the quick trades that we made both on Tuesday during the short trading day and also the trades that we made today. Again, what we do here on Option Alpha is recap all of these trades that we make practically every day with the video. If you're seeing this live on YouTube, we do this, post this video for the public about 5 days after the alerts go out so that you can't take advantage of these alerts without being a member on our website. So the first one I want to go over here is the closure of the Microsoft option that we had here today. So what we did is we bought back the vertical spread that we had in Microsoft, the 34.32 put spread. It's about $2 wide, and even though we took in a $15 profit on this, if you remember from a couple videos ago, we actually had entered this trade as a pure hedge against a call spread that we had in Microsoft as well. So the full position that we had in Microsoft was a big iron condor, and as Microsoft came down, we entered this put spread as a hedge and just added to the position as far as credits because implied volatility was really good, and it was basically free money for us since we already had the credit spread on the call side. This put spread didn't cost us any extra money, so we entered it for a 20-cent premium, again free money for us, and closed it out a couple days later for a nice $5 debit. So made $15 in profit around the whole trip per spread again, but this was pure hedge, so this was all free money that we had on Microsoft. If we actually go to the chart, take a look at what happened. We had entered the call spread up here when Microsoft was trading up in the high 38-39 region. So as the market went down, what we did is we closed out this trade above the market and re-entered this new order at 34 here. And so again, as you can see now that Microsoft has kind of rallied up a little bit, implied volatility has dropped a little bit. That obviously allowed us to close out this spread down below the market and take a nice profit on both sides. So this iron condor that we originally had on Microsoft, we both legged into and legged out of at the end of the day. So let's move on to the other closing order that we had today, and that was on the IWM. We sold our put spread that we had on IWM, made a nice $23 profit. This was on Tuesday that we actually sold out of the spread. Same deal with IWM as with Microsoft. Really no big difference here is that IWM is the major Russell ETF, and as the market continued to rally over the past week and a half, we just really took advantage of this quick dip that the market had here back in the beginning part of December. So as the market dipped, we entered this put spread, take advantage of some implied volatility in IWM, and you can see again, closing out the trade early. We don't want the market to reverse course, come all the way back down around, and take out our position near January expiration. So got a lot of time between now and January expiration, but as you see, we closed out this position for a $5 debit. That's basically as low as you can close it out between now and January. There's no point to keep this trade on to make an extra $5 on the trade. That's a lot of risk that you're taking. So we're taking a nice $23 profit on this and continuing to move on. So let's talk about the trades that we had entered on Tuesday. So again, these are designated by the Tuesdays. The first trade is that we sold a vertical spread in Cisco, and we sold the 23 call spread for 32 cents in credit per spread. So that's a very good trade for us, a very good premium. And I'll go to Cisco right now, and hopefully implied volatility is still about the same place as it was on Tuesday. Yep, and you can see that implied volatility was a little bit higher on Cisco. It's about 53 percentile right now, so it's above that magic 50% threshold that we usually look for. And again, the reason that we sold the call spread versus the put spread, because it doesn't matter which one we sell, it's all the same as you use the same probabilities, but is because Cisco has continued to move higher here over the past couple of days. I think it's running on about 10 or 11 straight trading days of profits. So I think there's going to be some downward pressure on this stock. And so what we did is sold the 22-23 call spread right above the market. Now, if we actually go to pricing, and I know that a lot of you have been asking to start seeing some of the pricing details. So again, you can see our position right down here below in Cisco that we have. So we're not making any of this stuff up. But again, you can see we sold the call spread right above the market. And right now, as it stands, remember we entered this trade on Tuesday and it's traded up a little bit higher. But right now, as it stands, we are in the 40th percentile for profitability. So What that means is that there's about a 42% chance that this trade loses money by expiration and about a 60% chance that it makes money by expiration. So a very good risk reward. When we entered it, it was kind of around 35% chance of making money or losing money at expiration. So this is a really good trade, and hopefully that kind of helps with this implied volatility and these probabilities, taking a look at those both. The next one we want to look at for Tuesday was Twitter. This was a hedge trade that we put on. We already have a call spread in Twitter that's a little bit in the money now. So what we did is we entered this put spread in Twitter to, again, add some free premium to our position. It doesn't cost us any extra margin because the market can't close both above and below our strikes. So I'll show you the pricing chart of this as well. But what we did is added to this position. Twitter implied volatility is still very, very high. The stock is going crazy lately. So this was a cheap, easy way for us to add some credit and start to chip away at kind of those losses that we might start incurring with the call spread position that we have on already. So I want to go to Twitter. We sold the 62.60 put spread in Twitter, and I want to go to that pricing chart here. So again, you can see down here below where our position is. We already had the 62.5, 65 call spread. So what we did is married up the same amount of contracts with the 62.5, 60 put spread, and we had trading the same amount of contracts. So again, it doesn't cost us any additional margin to enter this position. All we're doing is adding premium to the position. And then if we go to actual pricing diagram, you can see that we have the put spread here and the call spread here as well. So at this point, what we might do, because Twitter's already trading up to 73, it's had a huge run, we're just going to leave this position on. It's basically a big iron condor in Twitter, and we're going to hope that market cyclicality is going to push Twitter back down into the high 60 range. You see on the actual stock chart that it's gone basically parabolic over the last couple days, but it's starting to fail and stall out. You can see how the candlesticks on today's chart were a little bit more indecisive than they've been in the past. Very, very aggressive buy in the last couple of days. Today, a lot of indecision, and Twitter just marginally closed higher. So I would expect between now and January expiration, which is this dotted red line here on the chart, that at some point we're going to see Twitter come back down into the high 60s at least. And again, that'll allow us to have an opportunity to possibly take some of this off. Implied volatility should come down. But right now, we're feeling pretty good with this iron condor and Twitter. Just got to let the market work itself out. All right, so let's move on to the two trades that we made today. Implied volatility was a little bit more contracted today. So on IWM, we basically just traded a straight debit put spread. So we bought the 190 puts, sold the 180 puts, so it's a $10 wide put. And again, we're targeting always on these debit put spreads where we actually pay money to enter the trade, about half the width of the strikes for our pricing. So the width of the strikes is $10, and we're targeting about $5 for the pricing. We paid $5.15 for this debit spread. Again, just trading this very light. It's very wide, so we don't need to trade that many contracts on this. But if we actually go to IWM, you can see that we're definitely trading to the put side because of the huge rally that it's had in the last couple days. Again, it's had almost 6-7 days of straight upward movement. So all we're doing is betting that between now and expiration, sometime between now and expiration, that IWM is going to trade lower than it is today. And I don't think that's a far off bet. And this is what I tell people is that with implied volatility this low, it's not above that magic 50th percentile. We want to just take some of these directional bets when they become a little bit more glaring, right? This is a directional bet that IBM has been on a real strong move upward, a real bullish move. So we're going to make a bet that at some time between now and January expiration, which is this red line, at some point it's going to dip below this level, and we're going to be able to take advantage of it. And that's all it is. It's a 50-50 bet. So if it does, it does. If it doesn't, it doesn't. That's what we're going to do. We're going to wait, let the market work itself out, and have an opportunity at some point to take profits on this trade. The last trade that we made today, and I got a lot of questions about this, is a little bit different trade than what we usually make, but this is actually a naked put in the VIX. Now, I usually don't trade that many naked puts and calls or any strangles unless implied volatility is really high, but the VIX has been incredibly low recently. And while we've taken advantage, and members know, we've taken advantage of the move down in the VIX from the 15-16 region where we've made a couple $100s on that trade. Now we're going to take advantage of possibly just a quick move higher in the VIX. So what we did is sold 3 of the 13 strike puts, and we sold them for 45. So that basically moves our break-even point to about 12.5 on the VIX. And you can see when I go to the VIX, VIX, how low it is in the past even year, how low the VIX has been. It's been very, very low, and it barely gets down to this 12 region and then bounces right back up. So I'm betting that it's, again, between now and expiration, that the VIX is going to move up into this kind of 13 region where it likes to stay. It likes to stay when it gets back down in here around this 13 region. So that's where I'm targeting, and that's where I sold those couple puts in the VIX. So that's what we're expecting. Again, we've made a great profit on the move down in volatility. We bought a couple put spreads that took advantage of the market going down, starting to close those positions and starting to take advantage of possibly just a little move higher in implied volatility. I don't think we'll see the VIX jump right back up to the 15-16 region, but as long as it settles anywhere around 13, that's going to be a nice, healthy profit for us on this trade. So hopefully that makes sense. I'll go to the actual pricing of the VIX page so you guys can take a look at that as well. Pricing is a little bit weird on the VIX, and again, we did these January options, but you see our current positions here on the put side, we're just buying these options here. But then we have this one sell order that we already have in here at 13. And again, the pricing right now is about 45, same thing. Lots and lots of volume today, so very, very liquid. Lots of open interest, very, very liquid. But you see, you can't really break down to the next level below at the 12 strike because there's just no premium there. It's about 7 cents in premium per contract. It's not worth the risk. So we moved up to the 13s, which are just barely in the money today. But at 45 cents, that brings our break-even point down to about 12.5. So that's a pretty healthy trade for us. It just needs to move up about 20 cents in the VIX, which I think is a very easy, obtainable move between now and January expiration. It's kind of a no-brainer trade that helps get some profits rolling in with low implied volatility. So hopefully that's been helpful as always. Hopefully you guys like these. If you have questions or comments, please add them right below to the video. Let me know what you think. Let me know what you like seeing. If you like seeing more of this pricing stuff or more of the charts, always be here to help you guys with your trading and options. Happy trading.